Hello, and welcome to DBRS Morningstar's Credit Outlook. I'm Doug Turnbull, Vice Chairman and Country Head for Canada. For those of you familiar with this annual event, it's obviously going to be a little different this year. Unfortunately, we won't be coming to your city or meeting with you in person like we have in past years, but that's where the differences end. You will still be getting the informative insight and analysis you've always enjoyed with our past events. While planning for this conference, we reached out to many of you to see what interested you most. We also looked at some of the most topical requests on our DBRS Morningstar website. So we know we'll have a strong lineup of topics and speakers for you to enjoy from the comfort of your home or office. Over the next few days, we will discuss CMBS and commercial real estate post-COVID-19, sovereign debt and economic recovery, COVID-19 and credit implications for life insurance companies, ESG and fixed income markets, a Canadian structured finance update, and one that I'm particularly excited about, COVID-19 and the impact on liquidity management of the large Canadian banks. This session that will end the week features the treasurers from Canada's 6 biggest banks. So you can see we have a great lineup for you all. I also want to take a minute and talk to you about our business during this extraordinary time. At DBRS Morningstar, we take our commitments to our customers and all market participants seriously. That is why we would like to assure you that we will continue to be open for business. We're equipped with the best technology available, allowing us to deliver our ratings, research, data, and other products in a timely and efficient manner, while at the same time ensuring our key commitments to our customers: integrity, transparency, confidentiality, security, and investor success. Don't hesitate to reach out to our business development and client service teams or to me personally if you have any questions or concerns. I hope you enjoy the presentations and wish that you all stay safe and healthy. Thank you very much.
All right. Thank you everyone for joining. My name is Erin Stafford. I am the Managing Director and Head of North American CMBS for DBRS Morningstar. Today's panel is CMBS and commercial real estate outlook in terms of post-COVID world, or while we're still in COVID world. I think we'll look at that. Joining me today, I have 5 panelists and long-term colleagues who I'm also pleased to call friends. We have Norm Kamiri from Royal Bank of Canada. Norm heads up Royal Bank's Conduit, the Realty program. I'm Charles Gam from Institutional Mortgage Capital. Charles handles fund management for IMC, and IMC also is a past issuer of CMBS and servicer of CMBS as well. Joining us from the Mortgage Bankers Association is Jamie Woodwell, who manages is the head of commercial real estate research. And then 2 of my colleagues from DBRS, both senior members of our surveillance team, Gloria Au and Gwen Rausch, both of whom I've asked today to take on opposing views and give us a little bit of the Canadian perspective and also perspective of what's going on in the United States. So with that, I welcome all of the panelists to come off mute as you see fit. What we thought we would do, and I'm going to start by just sharing a screen, is provide you with a compare and contrast of the what's going on in the U.S. and Canadian CMBS market. So I think you can all see my screen. If I move on to this, we talked earlier in the week in terms of what we wanted to talk about at this panel, and we thought we could just stop here with the one slide. Canadian CMBS is obviously outperforming US CMBS, but that doesn't mean that there aren't concerns. And so what we want to do today is talk a little bit about those concerns. You can see basically in March, April, and May that both markets had an increase in troubled loans, but then obviously the Canadian market rebounded and is back to what we consider to be maybe a more normal delinquency rate, and the U.S. Market remains fairly elevated. So with that, maybe what I could do is turn it over to Jamie Woodwell to give us a little bit of insight of what's going on in the U.S. and then we'll compare that to what's happening in Canada.
Yeah, thanks, Erin, and thanks so much for having me. I'm really looking forward to the conversation. I think in the States, really the story of the pandemic has been a story that's been differentiated by property type more than any time that I've seen in the history. That if you look at the way the pandemic hit the U.S., it came in and sort of dramatically and immediately hit the hotel and retail sectors. We started taking a vacation from vacations. We had a variety of sort of state and local shutdowns that really curtailed retail activity. You had certain mall owners closing their properties. And so those two property types immediately felt the brunt of the pandemic and our responses to it. A number of the other property types, either because of lease structures or government support or other things, have held up far better. So if you think about the multifamily side of the market, there you've seen government support through stimulus checks, through expanded unemployment insurance and other things going directly to households and helping them make the payments. So that you've seen very little drop off in the share of renters making their rent payments each month. You think about the office sector and the longer lease terms, and even though folks aren't going into the office, you're still seeing those tenants paying their rents and leases on there. They're obviously longer term impacts there. So really, we've seen that concentration in hotel and retail to the point where in the U.S. Market, when we do a survey of $1.9 trillion of commercial and multifamily mortgage debt outstanding, if you look at the hotel balances, about 21% of that balance is now delinquent in the U.S. If you look at retail, it's about 12% of that balance is delinquent. And then the other property types, it's generally down in the 2 to 3%. I think sort of in general, what you've seen is now investors and lenders putting properties and property types into one of four buckets. There's sort of a bucket of counter-cyclical property types that investors actually think are getting a little bit of a boost from the downturn in the States. That would be things like industrial or with the logistics work going on there. There are some property types that are accelerated, where there were changes that were taking place and the pandemic has really accelerated those changes. I think you see that particularly with e-commerce and malls and retail. There is a set of properties that are perhaps changed forever, where there are a lot of people in the States looking at office properties and trying to figure out sort of if we fundamentally changed our relationship with how we interact with office properties and what that's going to mean for demand, not just during the pandemic, but going forward. And then lastly, there's a series of property types that are sort of speed bumps, where they were chugging along prior to the pandemic and recession hit that have affected them. But then the expectation is that afterwards we'll sort of get back to normal. That might be hotel and multifamily in that place. But in general, I mean, as shown in Erin's slide, there has been a very pronounced impact in the States to commercial real estate from the pandemic. And it's also been very property type specific. Does that sort of make sense, Erin? Definitely does.
Now, Norm, how does that compare to what you're seeing in the book that you manage?
Well, it's funny because I think the preface, certainly the Canadian preface, is that the Canadian commercial real estate market was probably in its strongest, or one of its strongest positions it has been in a couple of decades prior to the onset of COVID. So we started off in a very strong position. And while we've seen the same issues with hospitality properties, essentially everyone stopped visiting, vacationing, business travel. And so we saw some pretty significant declines in occupancy in the hospitality industry, and that's true across Canada. And that industry right now continues to be impacted pretty significantly by COVID. On the retail sector, I don't think we had the same issues, when COVID started as maybe existed in the US. And as a result, the retail properties in Canada, while we have seen some issues, those issues are predominantly associated with loans, or not loans, but properties where you have a high level of apparel or entertainment tenants that have had, I think, a much harder time during the closures and the lockdowns and the pandemic, generally speaking. The nice thing about Canadian CMBS is that our focus on retail has primarily been what I call necessity-based retail. So you have grocery stores, drug stores, liquor stores, and banks and other service providers that haven't really seen a significant slowdown in their foot traffic, and as a result have continued to operate almost as normal. And so that's really buoyed has allowed a certain amount of buoyancy for the retail sector, certainly within the CMBS market in Canada. From from another property type standpoint, I think certainly from an office standpoint, in March, we were running at somewhere between 5 and 7% vacancy in the Toronto office market, and as a result, that's considered in Canada certainly, or in Toronto, a very tight market. And as a result, we have seen some availability of space come back on, but I'm not sure that anybody really understands what the office market is going to look like, never mind in 6 months, but in 5 years. And so, I'm on the side that believes that office space there's going to be a continued desire for office space, a continued demand for office space. I think the utilization will be a little bit different. Human beings are wired to connect, and I think that connection, that networking that occurs in the office space is something that every employer, every company is going to want to continue. How that continues to me, is the big question. The industrial market in Canada continues to be incredibly strong. Demand continues to outstrip supply in most of the major markets and most of the secondary markets as well. With the just-in-time delivery and the pickup in online shopping that we've seen over this pandemic has certainly put some real pressure on the logistics of online retailers and the ability to deliver goods to the consumer. I remember in March, if you were looking to do a home delivery for groceries here in Toronto, you had to book your delivery 9 days in advance, and nobody wants their groceries delivered 9 days later. And so, a lot of the infrastructure that you may have in the U.S. or that has been developed in the U.S. isn't here yet. And so I'd say we're a good 5 or 7 years behind the U.S. in terms of developing that online infrastructure to be able to adequately service all the online shoppers. So I think Canada still has some ways to go in that particular area. But the markets here in Canada, generally speaking, continue to be robust. We saw a reduction in the transaction activity simply because people didn't know what to expect. And now that I think that we've been through this for 9 months or so, I think people have a better understanding, and I think all the media surrounding the vaccines, I think, is having a positive impact as well. We're starting to see the market return to normal, certainly on a transaction basis, and I expect that's going to just continue as things start to stabilize and we do see an end to the pandemic.
Great. I want to move back just based on one thing that you said, move back to Jamie to get his opinion, but real quick, just for the audience, feel free to submit any questions via the Q&A. We'll be monitoring that and certainly happy to answer questions as they come in. Jamie, one of the things that Norm touched on, which I think is a pretty interesting question that we certainly get a lot, is on, office use going forward. Is there this like boon to suburban office? Is it going to still be downtown office, but we return over time? What are your views on that?
Yeah, I hear those same conversations, a lot of debate going on, and at this point, I think we've got about as much information about that as we do about whether chocolate or vanilla is the better ice cream flavor. That is just there's so much out there that is going to be driven by your own view about office and how important it is, and that sort of a thing. You see huge range now of companies that have said, we're going to get back in the office as quickly as possible, and office users who are saying, don't even think about it before June, and then we'll start to see about sort of the new way we'll use the space. So I think there's a lot yet to be determined on that front. I do think that the fact that we've all been going into offices for so long means that there's an inherent benefit to that. And it's sort of hard to imagine that just overnight that would change, even with the technology and other things. There's some interesting data out now from Castle, the key card company, that shows office use. And on the one hand, it shows this incredible decline in terms of the share of workers who are in the office now, and down to sort of 20-ish% at this point in some of the major cities in the US. But then if you go back to pre-pandemic, it was up at, almost 100%. And I think that's a testament to the fact that there really are benefits to getting people together. I think, as Norm said, it might be more that we think differently about what kind of space we want in the office when we do go in, than that folks aren't going in. Personal opinion. And by the way, I like vanilla ice cream.
Aaron, if I could just chime in about the office use. One anecdotal thing that I would comment in talking to all sorts of different people, I would say that, and I count myself as being one of the older people now, I think the older you get, the more you recognize the benefits of having people together in an office. Norm mentioned the benefit of the network and being able to exchange ideas, just by looking to the side and so on. And I find with a lot of younger people, when I say younger people, my daughter's 18, but I have nieces and nephews that are in their 20s, and they think that working from home is seamless and should be no problem to do that forever going forward, because I hate to sound like the old codger, but I don't think they recognize the benefits that we see having worked in offices and having benefited from working with people, of having everyone in an office. And I think the real question that nobody has the answer for going forward is, how do you create an office environment that is safe enough for everybody, that makes sense. Our office isn't big enough to have everybody in it right now, but we don't know what the new environment is at IMC going forward. So we're holding off on making decisions for the future until we figure out, what can we do and what makes the most sense for the business, whether it's a combination of, working from home and working from the office. But there certainly is a strong belief that, in some way, shape, or form, we'll be back in the office when it's safe to come back to the office.
Sure. And I've certainly heard anecdotes from all kinds of people like yourself, where maybe if your lease is coming, maybe we don't know what it looks like, so we're looking for short-term renewal, or those that have really embraced it and have taken advantage of, lease comes due, we're going to downsize a little bit, or just, change. Maybe the open floor plan isn't the safe aspect anymore. So we want to do more collaborative type space, but a little more separate. So I think for sure the jury still is out on that. So we'll see how that is going forward. Maybe just kind of continuing, Charles, with you, like what, in terms of investing in CMBS and CRE, what do you think right now is the, within coming through this pandemic, what has really differentiated the Canadian CMBS product in terms of structure, or other things that you're seeing?
I hate to sound like the broken record, but Canadians are in all credit products, be they commercial lending, like a commercial real estate loan product, or even consumer lending. we are far more conservative than our U.S. Neighbors to the south. The fact that we have lower leverage, the fact that we have, for the most part anyway, and certainly 99.9% of Canadian CMBS loans have amortization. And I think, Norm, we're roughly sort of somewhere between 65 and 70% recourse provisions on our CMBS loans. I think those continue to be strong steps in making our loans more resilient to these short-term bumps and in the economy, because we've seen, and this may be too early to talk, but we've seen mortgage deferral applications, and it's a nice step to be able to say to a borrower who clearly is having difficulties due to COVID, to say, okay, we will defer your the principal portion of your monthly mortgage payments for, let's say, 3 months or whatever the term might be, and at least keep the borrower paying interest, which helps everybody out. So that is a nice step to be able to go, as opposed to if you're on an interest-only loan, there's really only one way to go from there, and that's deferring all of the payments, which isn't good for anybody, certainly not the bondholders in CMBS. But plus, when you have the recourse provisions that we have in a lot of, the 65 to 70% of our loans, you actually have a borrower who stands to lose something if he or she makes that decision not to make the payments and go into default and stand to lose. Once you've realized on the property, you still have the ability to go to Mr. and Mrs. Borrower and say, by the way, you still owe me the balance of the loan. That's not to be underestimated in these times either, I believe. So those, we've always had the difference between U.S. and Canadian CMBS, in that we have lower leverage with amortization and recourse, and I think those things are proving again to show that our statistics are better than what we see down in the U.S.
A question came in and from the audience in terms of maybe the viability of CMBS going forward, especially Canadian CMBS, given that its performance is so strong. Yet I know a lot of times it benchmarks off U.S. spreads. So what? I guess this question both to Norm and Charles, in terms of what's the competitive advantage for conventional lenders like Royal Bank or lenders like IMC, and if you have a CMBS exit, how does with CMBS spreads being a little bit wide, or how do you make that work?
Well, I think the key component, and interest rate is certainly an important consideration for a number of clients. But from our perspective, there's a number of different pressure points, I guess, that differentiate CMBS from where we are on balance sheet. Primary difference is term. So anything short term is on balance sheet, and anything from 5 to 10 years is CMBS, and that's primarily driven by the cost of capital. So regulatory capital means that we're not competitive if we try and do a 10-year loan on our balance sheet, because our pricing just wouldn't work in the marketplace. CMBS pricing tends to be a little bit more expensive than balance sheet or LifeCo pricing, and we are really just a function of the market. And so if the market perceives risk to be a certain level, we have to price it at that level. The risk, the pricing discrepancies, I think, are primarily market driven. But the difference between CMBS and balance sheet isn't just price. CMBS will do some non-recourse lending, will generally provide longer amortizations, will also provide for a higher LTV, going in LTV, higher proceeds. And that's primarily driven by most balance sheet lenders will have caps somewhere in the 60 to 65% range. And CMBS will often go, up to 70, sometimes even 75. And then we'll do property types that aren't don't have a lot of appetite, or traditional lenders don't have a lot of appetite. And that's, self-storage, manufactured housing, hospitality. And in this day and age, certainly after these past 9 months, retail is something that a lot of balance sheet lenders currently don't have a big appetite for. So that's something that we consider to do. So there's a lot of different, I think, pressure points with respect to how a borrower looks at different ways to finance their properties. And I think CMBS isn't for everyone, but I think it does allow some very attractive structuring features for those borrowers that are looking for those structuring features. If it's always the interest rate being the most important component, then CMBS may not be the winner every time. But ultimately, we have a very I think the transaction finance market in Canada is somewhere between $50 and $60 billion, and CMBS is really only aimed at a portion, or one tranche of that refinance market. It's not aimed at the whole $60 billion.
So one of the things that we looked at was obviously the delinquency graph and the Canadian delinquency rate. It's not zero, so maybe so there's obviously a little noise somewhere in the market. Gloria, what are the markets that you're watching in terms of markets of concern, and what are you seeing?
The Calgary office market is definitely an area of concern that the surveillance team at DBRS Morningstar have monitored for quite some time, and they've been struggling prior to the pandemic due to the downturn of the oil and gas industry, and we've seen a significant rise in vacancy, with the Q3 reporting almost 29% by CBRE. But in terms of rating actions that we've recently took, we rate the Bow Center Street, which is the first mortgage bond transaction secured by a 58-story, 2 million square foot office property in Calgary CBD. So the entire building is fully leased to Encana Leasehold LP and fully guaranteed by Ovintiv, formerly known as Encana Corporation. And our ratings on Ovintiv was actually downgraded to BBB low with negative trends back in June. And as such, the Bow transaction was also downgraded. And the lease on that property, it does stretch to 2038, but back in October 2019, the tenant announced its plans to move its headquarters to the US and noted that there would be no impact to the Canadian workforce. But it's worthy to note that approximately a quarter of that property is physically vacant, while 30% is occupied by subtenants. But it's a well-known fact that Calgary office vacancy has been high, where Class AA properties reported vacancy upwards to about 17.5%, Classes A, B, and C reported vacancy ranging from 30 to 40%, according to CBRE. And just generally, the sustained decline in the performance of Calgary office market over the last several years and a diminished outlook for meaningful recovery during the pandemic were considered as part of our rating action. And you mentioned, Aaron, about delinquency rates. So that really stems from the loans that have exposure to a sponsor, a prominent sponsor, strategic group, which backs a few of the Canadian CMBS loans. And that sponsor has a portfolio heavily concentrated in Alberta. And that sponsor itself, they filed for protection under the Companies Creditors Arrangement Act in late 2019, which was ultimately denied by the court, and the properties were placed in receivership. So this resulted in CMBS loans transferring to special servicing, and to date, these loans are actually over 120 days delinquent. 3 of the 4 properties secured in these loans had new appraisal values from February, which reported value declines ranging from 17% to 46% from their issuance values. And given the soft market, depressed oil prices, as well as the general risk to the Canadian economy during this time, the workout period for these loans could be extended, with value decline suggesting increased risk of losses to the trust at disposition. But it's worthy to know that these loans do have varying levels of recourse to the borrower and the sponsor, but there's definitely uncertainty surrounding the financial wherewithal of these recourse providers. In addition, given the sponsor's concentration of Calgary office properties that were included in the CCAA filing, the market will likely see an influx of properties listed for sale, which could dampen recoveries, prolong the holding period for these loans. But the servicer did express optimism regarding the ultimate resolution prospects, but there's certainly some hurdles to overcome when faced with ongoing market challenges along with the effects of the pandemic. As for the 3 conduit deals that we rate that has exposure to these loans, we place several of those classes under review with negative implications. And the plan is to resolve this designation once new public information becomes available. So aside from Calgary office, we're looking at the Fort McMurray market as well. And we've been monitoring several loans in that area, specifically multifamily properties that have been facing issues before the pandemic. The highly levered sponsored LREIT, they had a portfolio largely concentrated in Alberta and backed several CMBS loans, all of which reported occupancy and DSCR declines in the last several years, and sparked again by the downturn in oil and gas, as well as facing several natural disasters like the wildfire and flooding. These loans were in special a few years ago, but was returned to the master after a loan modification that included lump sum principal payments, as well as the maturity extension. At the beginning of the pandemic, relief was requested and ultimately granted, which included deferral of P&I or a switch to IO payments for a period of time, which were to be collected with compounded interest, if any, at the newly extended maturity date. There's also one additional loan in Fort Mac that's a hotel property, which we've been looking at for quite some time now for the same reasons, property performance decline driven by the local economy, where the borrower was granted mortgage relief as a result of the pandemic, where they can use their FF&E reserves to make P&I payments. And now the borrower is now dipping into the replacement reserves to make its principal payments while the borrower covers the interest portion. So there is a repayment plan to replenish these reserves that's expected to start in November. But, in summary, these are the areas of concern that our surveillance team is constantly monitoring, and will provide, updated commentary on our Viewpoint platform as new information becomes available.
So it sounds like primarily Alberta.
Yes.
Yeah,
and if I can, I'd like to provide a little bit of perspective with that. I think the issues that Gloria identified are one, Calgary office is a market that has seen its boom and busts over, and is intrinsically tied to the oil and gas industry, and has seen its boom and busts probably over the last 30 or 40 years. But the key component of the Calgary office market, there's not a lot of it in CMBS, primarily because a significant portion of that Calgary office market is institutionally owned, the BO being owned by one of the larger REITs here in Canada. And that has, I think, alleviated some market concerns, primarily because the properties being institutionally owned tend to have deeper pockets and able to sustain longer periods of higher vacancy and those types of things. And we have started to see that market try to reinvent or to reutilize a lot of that space into different segments. And so, I think the jury's still out as to how that's going to happen. But I think that's, positive development for the Calgary office market. With respect to strategic group, again, that's a BOR concentration issue, or that's a BOR specific issue. It's not a systemic issue. And I think that'll be worked out. There's a significant amount of real estate equity tied up in strategic groups' overall portfolio. And I think that once that is unlocked, and COVID is certainly not helping that, but once that is unlocked, I think you'll see a right sizing, or a lot of those issues will be resolved, whether it's through the courts or directly. And then Fort Mac, Charles can speak to Fort Mac. I think he's much closer to it than I am. But again, that is intrinsically tied to the oil and gas industry, or has been, and has suffered essentially since the wildfires of 2015 had a pretty significant negative impact on that market. So it is they all happen to be in Alberta. I want to make sure that there's an understanding that the Alberta market is actually still quite robust. And, from the bank's perspective, we haven't seen an increase in delinquencies or bankruptcies, whether it's in commercial real estate or whether it's in consumer lending, in the Alberta market. Certainly no more in the Alberta market than in any other market. And to be perfectly honest, it's been relatively stable in across Canada. But I think that speaks to the fact that the Alberta market has moved away to a large degree, or is moving away to a large degree, to its predominance or its reliance on the oil and gas industry. If you look at Edmonton, for example, you have to look at the 18th largest employer before you find an oil and gas company. And so there's a lot of things going on in Alberta. So I want to make sure that we don't all paint it with the oil and gas brush, because while that may have been true 20 years ago, I don't think it's true. It's no longer true, in 2020 or going forward in 2021.
I guess I'll take this opportunity to open the lid a little bit on Fort McMurray, because we are a big investor in bonds, the BP's bonds of the deals that have Fort Mac exposure. We are certainly monitoring that market very carefully. Since the price of oil dropped below $100 a barrel to whatever it is today, that market has been under a lot of stress. But I can't underline enough that it's been almost 5 years that market's been under stress. Notwithstanding the COVID-related deferrals provided this year, the loans, for the most part, have stayed current because we have a sponsor who is committed to the properties and has kept the loans current, as well as through the forbearance agreements having been negotiated, has paid the loans down out of his own pocket by about he will have paid down $12 million out of his own pocket over the 5-year period through the forbearances. And the fires of 2016 were mentioned. We were concerned that the fires would result in negative events, but in fact, when fixing up the buildings after the fires, this sponsor also upgraded the buildings at the same time, so has not demonstrated that he or his company is willing to abandon those properties or those loans anytime soon. And to be fair, we have recourse to the principal behind the organization that owns and manages the properties. He has behaved in all ways very much like an owner who wants to keep the properties and wants to keep them going. We always say in the office, if these properties were located in North Dakota and in the shale oil markets there, the keys would have hit us on the head a long time ago as the owner would have departed those properties. But again, speaking to the benefits of having recourse loans, we have a borrower who actually has skin in the game and is working with us and working with the limits of the market to see, to make sure that these loans come out at some point in time down the road. The fact that the 6 downtown properties were evacuated on April 28th due to flooding was certainly not COVID related, and those properties are coming back online. And we are very pleased that the owner and the sponsor of those loans is doing the work. Like, I just got information on those properties that he's not spending millions of dollars, but he's renovating, he's repairing the damage, he's getting things ready to the extent that they are open for business. They are open, and he expects to be, within a reasonable point in time, back to pre-flooding, pre-COVID income levels, which are still not as good as they were in 2014 and 2013 when the loans were originated. But all signs are pointing to an eventual, and I can't stress the word eventual enough, an eventual resolution of these loans.
Great, thank you.
And maybe to close the book on Calgary office, I don't think it's a coincidence that we haven't seen a Calgary office loan in a Canadian CMBS pool in the last, I don't know, Norm, has it been 2 or even 3 years? At least. I don't think it's a favored region or product type for any lender, be it CMBS or bank, at this point in time, and for the reasons that we've talked about. So And again, I can't underline enough what Norm said. This is Calgary office. This is not Calgary multifamily. This is not Calgary industrial, nor Calgary retail. All those sectors are performing, as well as you would want them to be. They would fit right in any other region in the country in terms of performance. It's really just an office issue, not a Calgary or an Alberta issue. It's a Calgary office issue.
Yeah, I think that's really interesting. Gwen, do you have any thoughts on how maybe that compares to, if we liken Calgary to Houston, is Houston the same, where it's only got, one asset class under stress, or are you seeing it across all property types?
Well, I think Charles nailed it. I mean, obviously, what's seeing in the United States is a totally different picture. He mentioned North Dakota, you're talking about Houston, and I think in both instances, we've seen increases in delinquency across the property types, and it was a combo. You have an economy in Houston that has also diversified over the years, and they have less reliance on oil and gas, but that concentration is still there. And you kind of had some comorbidities with that market, where you had overbuild of hotels, and you have the standard U.S. concentration of retail properties. You had some overbuild of multifamily. So we saw stress across the property types, very pronounced in hotel to begin with, and office properties, obviously, particularly those in the energy corridor and some of the suburban markets. I think, Houston's kind of seeing what was happening with some of the other markets in the U.S., where a preference for downtown is being seen. So I think you see some pockets that are doing well, but, like you said, across property types. And as soon as things start to go south, those borrowers in the U.S. that have a Houston concentration, they're not hanging around very long. We have some instances where they're trying to hang on and they're engaged with the servicers on things, but by and large, obviously the uptick in properties that are eventually in the hands of the servicer is much higher in those markets.
Now, Gloria mentioned, just on those handful of distressed assets, some of the value declines that we're seeing there. I guess to Jamie and Gwen, how does that compare to what we're seeing in terms of value declines in the U.S.? I know it's property and market specific, but any generalities of what you're seeing there?
Sure. Gwen, do you want to go first? You want me to take a crack?
Go for it, Jamie.
All right. I think right now, as with so many things in COVID, there's a fog that it's hard to really see through what's going on. Someone had mentioned earlier that transaction volumes are down significantly. So that certainly is cutting through some of the usual measures we would use to understand what might be happening. I was looking just the other day, two of our major gauges of values, Real Capital Analytics and Green Street Advisors. One shows, I think it was a 7% year-over-year increase in commercial property values. The other showed a 10% decline. So it's really tough to get a handle on that. Just sort of one other piece on that. If you look at the data from the National Council of Real Estate Investment Fiduciaries, NACREIF, that bunch of large institutional investors that every quarter report on their portfolios, and you saw that in a number of different property types, the incomes had dropped sometimes pretty dramatically compared to a year ago, but the values had held steady, which just by the math of it means that the cap rates had actually gone down during this period of uncertainty. So I think there are a lot of things that are going on as investors are trying to figure out sort of what's on the other end of the pandemic and what's going to be the income and value of a property, and then how likely is a particular property to get from here to there. But as a result, my sense, and Gwen, I'd love to hear your thoughts, is that there's not really a whole lot of clarity yet on what's really happening with property values in the U.S.
Yeah, I agree 100%. I think, kind of what we can observe is really anecdotal. It's hard to take what's coming in and say, okay, these speak to trends, because really what we have updated appraisals for on the existing legacy transactions is, loans that have hit the 60-day delinquency mark, and the servicer has gotten the appraisal and has finalized and it's flowing through to the IRP. And then what we're seeing as we're looking at these deals is those are assets that had issues prior to COVID. So those were, I think, what we see in the data is those are the ones that went delinquent right away. So obviously we're getting those appraisals. And so it's kind of a mixed bag. Yes, you have a value decline, but that's to be expected if you had a cash flow decline prior to issuance, or prior to COVID that, was indicative of some issues that were, I said comorbidities earlier. We've talked about that, like, these markets or property types that were showing some stress, like regional malls is a good example in secondary markets. When we've gotten appraisals in on those, obviously those are coming in, significantly lower. Hotels that were performing, pretty well prior to COVID and they just need some temporary relief right now, we're not seeing as drastic of declines. If it was, really a challenged hotel with a low DSCR, yes, drastic decline. So I think where we're going to be able to start being able to extrapolate from the data and say, how is this really impacting, is these loans that were performing before COVID, they're with the special servicer right now. They're trying to figure out a modification to get the borrower over the hump. They were performing before. They just now went, to the 60-day, 90-day delinquency mark where we're going to see a new appraisal coming in. Like, how do those values compare? If you really didn't, their issues are purely COVID driven. How are appraisers treating that? And I think we'll have more clarity on that as the year goes on. I was looking at the data. I think it's like 70% of the delinquency that we pulled is at the mark that a new appraisal would be ordered. So I think we'll start seeing more of that coming in, towards the end of the year and first of next year.
Thank you. One of the things I think, what we were looking at and talking about a little bit ago was just that, and as you mentioned, Gwen, that COVID relief request that came in. I think on one of our calls before we jumped on the webinar, Norm, you talked about the deferrals that you saw, and I feel like you could tell us on, pretty simple statistics of what you've seen, the deferrals that needed to be granted because of COVID. And then, there does not seem to be an ensuing, transfer or continued stress, because Gloria kind of covered what's currently stress. How are the deferrals working their way through?
I think the majority of the deferral requests that were done in the first few months of COVID. So we saw somewhere in the tune of between 70 and 80 deferral requests between March and May of this year, when nobody really had any understanding as to how long this was going to be, what it was, how bad it was going to get. And so a lot of people just, and here in Canada, the government said that they would support, consumers as well as businesses going and asking for deferrals to the bank. So we saw an onslaught of requests. In the CMBS world, we saw, somewhere between 70 and 80 for the realty transactions. Of those, about 33 were approved. Of those 33, there's currently 26 of them have come off deferral, and most of the deferrals were for principal deferrals with the borrower paying interest for anywhere from 2 to 6 months. So the majority of the requests, or the majority of the approved deferral programs have since expired. Borrowers are back on principal and interest payments, and they've started repaying the deferral amounts. So it's been a very, very well managed, very small portion of the market that we saw with respect to deferrals. And the concentration was on the hospitality loans that we had and some of the smaller retail loans that we had as well. And for the most part, what we hear in speaking with our borrowers, our clients, and 90% of loans that are in our Realty CMBS are existing bank clients. So we have a pretty good relationship with the majority of them. And what we hear is that while there was a panic certainly at the beginning because nobody really understood what was going on and for how long it was going to go on and what the real impact was, I think that as we've managed through the past 9 months, and certainly now with all the talk of vaccines, I think people are much more confident that while this is having an impact on my business and it's having an impact on my tenants, it's finite. It's not going to go on forever. And so there's a great deal of optimism that once the vaccines are generally available, that business will kind of start stabilizing and become, go back to normal or whatever the new normal is going to be. So from that perspective, while there were a number of deferrals, most of them are off now here. And the ones that aren't are generally making payments from collected reserve accounts. And the ones that, the ones that had longer than 6 months deferral periods were all hospitality properties. And no one really knows when that segment of the marketplace is going to come back. I know that travel is still very restrictive, even domestic travel here in Canada. International travel is very difficult. And until that starts to pick up, and until people feel safe and confident in moving about a little bit more, I think hospitality is going to continue to be under pressure.
Yeah, I would agree that our experience in servicing CMBS loans, our statistics are very, very comparable to what Norm outlined. I think we have a smaller portfolio, but we had 38 deferral requests made, 24 of which were granted. Unlike, and Norm, I'm not talking about your CMBS platform, I'm talking more about the bank balance sheet lenders. It's my understanding that the banks on their balance sheet loans just wholeheartedly provided automatic loan deferrals of whether it's 3 months, 6 months, or IO versus P&I or full P&I. We didn't do that because we also understand in CMBS that there are bondholders that need to be paid. So we created a very strict protocol where if a borrower asked for a mortgage deferral, we asked for all kinds of information. And when I say that, only 24 of 38 deferral applications were processed, it was amazing to see that when borrowers discovered the kind of information that we were asking for, which included, operating statements, rent rolls, and any capital payments made out to sponsors in the last 3 months, a number of borrowers just said, "Oh, never mind, I'll just make the payment. I don't need the deferral." And that's really what we tried to do. We certainly were conscious of the effects of COVID on certain businesses. And as Norm said, retail and hotel were the big ones affected by COVID. We weren't denying COVID deferral requests wholeheartedly, but for the most part, they were very short-term in nature in March and April when the majority of the requests came in. Nobody knew how long things were going to last. And so our attitude was, we'll give you a 3-month deferral of some kind. And at the end of the 3 months, if things are still as bad as they seemed to be back in April, we could talk about extending them at that time. But how do we know what's going to happen in April? What would happen in 6 months out? So we tried very much to make it as short term as possible. And similar to what Norm said, virtually all of those deferrals are off the deferrals, and the vast majority provide for accelerated repayments of the deferred amounts. So for example, you might get, I'm just picking, May, June, and July of interest only, and then in the 6 months after July, August forward, we would look for you as the borrower to repay those deferred amounts over the 6 months immediately after the deferral period. Those are all being honored to my knowledge. The last time I checked, nobody was delinquent, or nobody was, that I'm aware of, was saying, "Oh, I can't make these accelerated payments, you have to give me more deferrals." We did have a couple of people come and say, "I need more than 3 months," and where required or where COVID was truly having an effect on the cash flows to the property, those deferral periods were extended. But to my knowledge, it's very much a past event as opposed to an ongoing event at this point in time.
Thank you. So we're almost up on the hour. We've got, I guess, an audience question that we can wrap up and maybe into the final question. Final question really is on the future of Canadian CMBS and what that might look like going forward as a basis of comparison. We've seen US CMBS limit hotel exposure, limit retail, and obviously with agency being the dominant multifamily lender, US conduits tend to have less multifamily as well. So you're ending up with portfolios of a lot of office, self-storage, and if we can get industrial, that'd be great. So curious, your thoughts on the future of Canadian CMBS, if there's any changes that result because of COVID. And then the audience question is if you see or expect Canadian CMBS issuance to increase over the next few years with the implementation of new Basel requirements.
Okay, well, for the first part, two pretty different questions. For the first part, I think, to reiterate, I think the Canadian retail experience is quite a bit different than the US experience. And because we're primarily focused on the necessity-based anchor tenant or cash flow stream, we expect that retail will continue to be a sizable component of Canadian CMBS. It's proven very resilient. It's proven consistent and stable, and we expect that will continue. I think short-term hospitality, given the significant stress that it currently is seeing, and that's across Canada, I don't think that we'll see any Canadian deals with hotels in them in the short term. And until this regulates itself, until COVID is dealt with through vaccines or otherwise, I think that will continue. What we've seen over the course of the last few years is an increase in the percentage of our deals with multifamily. I think that will continue. We're going to see a larger segment of the multifamily market in conventional lending, and as a result, in CMBS. And then, we see industrial, self-storage, some office, but those will be the primary property types, and they always have been. Hospitality has always been a very small sector in the Canadian marketplace. I think it runs generally around 6%. So it's not a big portion of the CMBS market. I think retail, multifamily, industrial, office, and self-storage will continue to be the primary property groups going forward. And I do expect that we're going to see an increase in issuance. We'd love to be able to do 2 or 3 deals a year. The market, if you'd asked me this time last year how many deals Realty would do in 2020, I would have said 3, because we were poised to do 3 deals. Of course, I would have been way off, because I certainly didn't see COVID coming in November or December of last year. So assuming that the market conditions allow, I think we're going to see a pretty good increase in Canadian CMBS issuance. And I think that kind of dovetails into the question that was asked with respect to, regulatory requirements, whether it's Basel 4 or IFRS 9. I think what we're starting to see is more pressure being placed on the Canadian banks' capital in terms of making sure that we're holding enough capital for the risk associated with real estate. And some would argue that some banks have maybe not been doing that as much as they should. I think we will see. I think we will see a pressure on all the regulated Canadian institutions to start looking at ways to provide liquidity to their real estate books. And, for RBC, CMBS has proven to be a very good mechanism for allowing for that. So we're certainly going to continue. BMO was part of our deal in 2020. I expect that they're going to continue as well. And I wouldn't be surprised to see some of the other larger institutional lenders start looking at CMBS again.
Great. Charles, any last thoughts?
I really hope that what Norm says comes to be true. We would love to get back into the CMBS landscape as an active issuer. That's not possible at this time, but along with what Norm says, with more participants and more issuers and more issuance, we would hope that bond spreads would come in. And that makes loan spreads more attractive to get a bigger share of loans. It's, it's a never-ending story, but and as an investor in B pieces, if there's more B pieces to buy, we certainly love them as an investment as well. So looking forward to seeing more going forward.
Great. Well, I wanted to thank all my panelists today. I think it was a very lively discussion, and wish you all well. And thank you to the investor who suggested this topic. I think it was a lot of fun.